Hi guys, my name is Mike Boyd, this is the Money Flare, and in today's video I want to present to you my top 7 investing tips. And these are tips that I've sort of discovered for myself through my own experience investing in the markets, as well as doing my research on other really successful investors. And I hope they can be as useful to you as they have been to me. So without further ado, let's get to the list. First on the list is have a process. Similar to how an athlete needs to have a game plan in order to win, or how a company needs to have a documented set of procedures or guidelines in order to run certain aspects of the business, every successful investor needs to have a process and a framework. And this process guides their decision making. This is first on the list because I think it's the most crucial aspect of any good investor. Investors who don't really know what they're doing and who just sort of buy companies they like, or they chase charts or whatever it may be, they may have good performance and good results in the short term, but chances are they're probably going to lose in the long run, and they'd be better off just buying an index fund, for example. So I think the key to success and the key to outperformance is to have a good, solid, robust process that evolves over time. And by process, I mean the rules that govern your decision making as an investor. So these would be things like what asset classes do you invest in, or what is the overall makeup of your portfolio? What do you buy and what do you sell? When do you buy and sell, and how much? And you need to find a process that works best for you. I can't really say much in this respect. I can always give my opinion and my views, and I will talk extensively in future videos about what I think is a winning process. But at the end of the day, you have to decide what works best for you. So if being more of a passive investor works better, then that's great. That could work for many people. And so your process may be simply just buying an index fund once a month at the beginning of the month, every month. That could be your investing process, and that works for a lot of people in the long run, right? So once again, it's up to you to decide what process works best. But with that being said, I've always believed that putting in the effort to becoming more financially aware and being a bit more active in your investment style can have substantial rewards as long as you know what you're doing. And the whole point of this channel is to provide information and to present topics that can hopefully be useful for you to developing and improving upon your own investment process. So number 1 by far is to have an investing process, constantly improve upon it, and adapt and change over time to the different market environments. Number 2 is to keep in mind the big picture. No matter what you do, you should always keep in mind the overall macroeconomic environment. And so that would be, what are the long-term trends and cycles, and where are we in those long-term trends and cycles? Because at the end of the day, the economy and the market structure and the inflows and outflows, all those determine asset prices. You can do all the fundamental analysis you want on one individual company, but if you don't have a picture of where we are in the overall cycle, you can't accurately position yourself within each cycle. So that means evaluating things like, what does GDP growth look like? What is inflation doing? Where are interest rates going? How does the yield curve look? All these things would constitute the overall macro picture. And this isn't stuff you have to figure out for yourself either. I'm always going to give my opinion on what I think is going on and where I think we are in the current cycle. But there are other resources you can look to as well. There are other people online, on YouTube too, who talk about these things. There's financial advisors you can resort to. There are other research and services that you can pay for that can give you the overall macro picture. Tip number 3 is to be diversified. People often create portfolios with asset classes that they believe to be diversified. So like stocks and bonds and private equity and commodities, all these things. But when we've seen crises occur, like in December 2018, or March 2020, people tend to then realize that what they thought was diversified actually wasn't really diversified at all. So when the poop hits the fan, everything goes down at the same time. And that's not true diversification. Having different positions that reflect the same underlying trade is not being diversified. So buying, let's say, 20 high growth stocks is essentially putting all your money into one trade. At the end of the day, there are only 2 types of assets, those that are long volatility and those that are short volatility. And what do I mean by that? So in a previous video, I mentioned that volatility is just the expected range of a price for a particular asset. And so when markets are crashing, or when there's some type of major event happening, volatility usually rises. And that means that markets are usually crashing, or prices are usually coming down. And so an asset class that goes up when usually things are doing well, that would be your typical short volatility asset class. But when an asset goes up when things are going bad, that's more long volatility. So though you want to have a balance between those two. You want to have a balance between the asset classes that go up when things are good and the asset classes that go up when things are bad, so that you can have more of a balanced, diversified portfolio. A portfolio is like a team. It's not about the individual pieces, but how they work together that matters. And so like any good team, you need to have an offense and a defense. So stocks would be typically your short volatility position. They'd be your offense. And things like gold or bonds or put options, they would be more or less long volatility, and they'd be your defense. And once again, as I said, it's about having a balance between the two. You want to have your offense performing well when things are going well, but then you also want to have your defense protect you from any downside moves. And so having those two balanced is what makes you truly diversified. Number 4 is manage your risk. All the best investors know how to manage risk properly. So have proper position sizing where you're investing enough money to make a gain, but not investing too much where you're risking your portfolio in one trade. Diversify your portfolio, hedge your portfolio, take profits. These are all key aspects of proper risk management. While it's important not to take on too much risk, all the best investors know how to concentrate risk when the opportunities arise, like in US Treasuries in November 2018 or in March 2020 with US small cap stocks. These types of opportunities don't come often in your investing career, so it's important to take advantage of them when they do come by. Being able to take risk and manage risk is a tightrope that we all must walk along as investors. And like everything that I say, what's usually best is a balance between the two. You want to be risking enough where you're making money, but not too much where you're going to blow out yourself if one trade goes bad. So the balance is key to long-term success. Tip number 5 is don't be dogmatic in your views. As I mentioned in a previous video, it's important to always listen to the market. And it's based on the idea that the crowd is collectively smarter than any one individual. This concept was first discovered by a statistician named Francis Galton, who in 1906 observed a competition at a local fair where 800 or so people were trying to guess the weight of an ox. And while each individual's guess was not really that accurate, to his surprise, the average of all guesses was within 1 pound or so of the ox's actual weight. And many studies since then have been done that give the same result, that a diverse crowd is way more accurate at predicting outcomes than any one individual. And as much as you can, don't fight that. You can always have a personal view or a thesis for how you think an asset price will go, but if the market goes against you, you should not be dogmatic in those views. Have a deep respect for the market and use it to your advantage. Be open-minded and humble enough to admit that you're wrong and to change course when the market signals tell you to. So whenever making a new investment, you should always open a small position first and then add to it if the market confirms that you're right. Let your winners ride and cut your losses short. And at the end of the day, your only job as an investor is to make money. It's not to be right. And you should always remember that. Number 6 is go against the market when the time is right. And I know I'm sounding like I'm sort of contradicting myself because just earlier I mentioned how the crowd is always collectively smarter than any one individual, so you should always be following the crowd. And while that may be true most of the time, the key word that I used there was diverse. A diverse crowd is always what's best. And that diversity of opinion is what makes the market and what makes the crowd so good at predicting outcomes. But when that diversity goes away, it pays to go against the grain. Much of this is based on the work of economist Blake LeBaron in his 2001 research paper. And in it, he simulated a market environment. And what he discovered was that prior to every market crash, population diversity falls. So what this means is that the diversity of thought within the market falls. People start to think the same way, they start to take on the same trades, and everyone's essentially all in. And what this does is it makes the market very brittle and very fragile, and any catalyst can set off a major decline. When the market is so one-sided, it becomes very hard to trade with anyone on the other side. So when everyone's all in, for example, and prices start to come down, it becomes harder and harder to find anyone to sell to. And so this creates these sort of crises that we see where markets tend to trend and then revert, and they move in cycles like a wave. So when the market is clearly trending in one direction, but the consensus view is that it doesn't really make sense, similar to last spring, for example, then that's when you want to be all in. That's when you want to be riding that wave, because that's the diversity of opinion of the market working well and confirming the truth. But when that trend eventually becomes consensus and everyone is essentially thinking the same thing and everyone's all in, then it pays to be going against the crowd in that situation. That's when you want to be taking the other side of the trade. And while for the most part I do try to follow the trends as much as possible, most of my own outperformance has always been when I've been on the other side of the crowd when the time was right. And last but not least is to be patient. investing in these crazy markets can be pretty tough psychologically, especially if you're highly concentrated in certain stocks, or if you're jumping from headline to headline, getting caught up in the short-term volatility. It can be pretty tough on your mental state. So that's why being patient and having a calm mind is one of the most important aspects of any good investor. I still struggle with this sometimes because, believe me, it's not easy to stay patient when you see your portfolio drop 30% like last March, or when you're sitting on the sidelines waiting to buy a stock and all of a sudden it starts taking off and getting overbought. In these moments, you don't want to be impulsive. You never want to be investing on emotion, because those are the times when you're most likely buying at the top or selling at the bottom, and that's definitely not what you want to do. How you handle pressure is important, and it can only really be learned through experience. You have to be in the markets and experience it for yourself with your own money before you can truly develop this important skill. Don't act when you're emotional. Step away from the screen every now and then. Don't look at your portfolio every day. Don't chase trends. Don't try and pick tops or bottoms in the market. And most of the time, the best thing you can do for your portfolio is absolutely nothing. Listen to Warren Buffett. He's been in the markets for decades, and he once said that the market is a device for transferring money from the impatient to the patient. So you have to be sort of a Zen Buddha of investing. So those are my top 7 investing tips. I hope you guys enjoyed it, and I hope they can help you to become better investors yourselves. Obviously, this wasn't an extensive list. I probably left certain things out because at the end of the day, I'm still learning myself. But these are certain guidelines and certain rules that I found have helped me a lot in my own investing journey. And so I hope they can help you as well. And obviously, it's easier said than done. I often break some of these rules myself. And so it's not always easy to follow all of them, but I think it's important to at least keep a certain set of rules and guidelines in your mind, and just to sort of try and abide by them. And I think that at the end of the day, that is the key to long-term success in investing. So I hope you guys enjoyed the video. Be sure to like and subscribe, and I'll see you at the next video. Take care.